In our markets, it is now $2,000 per month more expensive to own a home versus rent a home. And so that's true across the country, but particularly acute in our markets. And so that's leading to turnover that's significantly lower than historical levels and generally supporting overall demand for our communities.
Joining me today is Ben Schall, President and CEO of AvalonBay Communities. So Ben, how would you describe the macro operating environment for AvalonBay today, and how are you positioned to react?
Yeah, thanks for having me. On the operating front, our operating results and our operating momentum have been stronger than we originally anticipated for this year. As part of our Q1 2024 results, we increased guidance and are now projecting amongst our peer set some of the strongest revenue, NOI, and core FFO growth in the sector. And then our operating update that we issued before this conference showed continued momentum on the operating front in April and in May. And I'll highlight a couple of the drivers behind that momentum. Starting on the demand side, really two elements that I'd emphasize. One is job growth has been stronger than we originally anticipated, and particularly for our core customer, we call it a knowledge-based worker, college-educated worker. Wage growth, job prospects, all in a pretty strong spot today. And so that's helping demand for our apartments. The other element on the demand side to emphasize and highlight is what we refer to as the rent versus own economics. And in our markets, it is now $2,000 per month more expensive to own a home versus rent a home. And so that's true across the country, but particularly acute in our markets. And so that's leading to turnover that's significantly lower than historical levels and generally supporting overall demand for our communities. Switching over to the supply side, so that's the demand side. On the supply side, which is definitely a factor for our industry, we at AvalonBay benefit that we just are up against significantly less new supply, really, than anywhere else in the country. And that speaks to our portfolio, which is 70% located in suburban coastal markets. And so both that demand and supply is leading to outsized results in our industry. And if I was going to summarize sort of across the country, what we're seeing is East Coast is generally outperforming the West Coast, and both the East Coast and West Coast are outperforming the Sun Belt markets. And then secondly, our suburban markets are tending to outperform our urban markets today. All of that driven by the supply and demand dynamics that I talked through.
What are some key issues that you see impacting the sector in the next 6 to 12 months?
Yeah, top of mind for the sector are the supply dynamics, which I just referred to, and we're fortunate that that's less of an issue for us. What we're really excited about at AvalonBay are a set of strategic initiatives that we're investing in heavily and focused on that we believe can drive superior growth for our shareholders. And I'll highlight a couple of them. One is what we refer to as our operating model initiatives. These are a series of investments that we're making in how we service our customer. And through the use of technology, centralized services, on-site teams, we're really transforming that process, and it's allowing us to deliver more value to our residents while also driving pretty meaningful operating efficiencies as well as drive incremental revenue. We had an investor day back in November of 2023, and this was a big focus of ours. And as part of that investor day, we actually put out a target in terms of how much incremental annual NOI we think we can drive from those operating initiatives. And we increased it from $55 million to $80 million of incremental annual NOI. At the end of this year, at the end of 2024, we're projecting to be about $36 million on that journey. So I summarized that in that making really good progress on our operating initiatives and also a nice runway ahead of us in terms of future earnings and value creation to come. So that's one big area. Second big area for us is our development platform, which is a unique aspect of our business and definitely a driver of earnings and value creation for us. We have about $1 billion of projects that are in lease up today, and they're outperforming. Rents are 10% above pro forma. Our projected yields on those developments are 40 basis points above our prior expectations. They're coming in at about 6% yield on costs. So generating meaningful value for our shareholders and also a nice driver of incremental earnings going forward. The other part of our development, and this is newer for us, is we're also now providing capital to third-party developers. And we've got two programs there, one which we refer to as our developer funding program, where we provide full capital stack to a third-party developer. and the other one is our structured investment program, where we provide preferred equity and mezzanine loans to third-party developers. Those are very much in the scope of tapping into our strategic capabilities, and particularly our development and construction know-how, as a way of driving incremental earnings for shareholders. So you put that group of activities together, we think we have a pretty unique offering in terms of driving both internal growth out of our existing assets, as well as driving unique external growth going forward.
And can you talk a little bit about acquisition opportunities and also disposition opportunities in the current market?
I would generally describe the transaction market in multifamily as one that's thawing. So from its frozen mode into a thawing mode. And we are starting to see some increased individual asset transactions in the marketplace, as well as some larger portfolios. So that process, we expect more of that activity to build as we make our way through 2024. In terms of our specific activity, we are in the process of selling about $400 million of assets, something we do traditionally every year. Those are pricing at a 5.1% cap rate. And so in terms of the transaction market today, as we described just generally where pricing is for institutional quality assets, the type of assets that an AvalonBay would own, generally we're seeing the range on the cap rate from a 4.75% range up to about a 5.5% type of range. That's on the disposition side. So then you switch over to the growth side of the business, and there I'd really emphasize our balance sheet. We have one of the strongest balance sheets in the sector, really have one of the strongest balance sheets within all of REIT land. And so in terms of our access to capital, our cost to capital provides us with a real advantage. And increasingly, as we're thinking about opportunities and buying opportunities in the marketplace, what we want to do is tap that balance sheet strength and flexibility, as well as tap into the strategic capabilities that I referred to, and particularly tap into the operating model initiatives that we're underway with. Inherently, how do we generate and drive incremental value by having an asset on the AvalonBay platform? Could be an incremental development, could be an incremental acquisition, but we want to be able to generate outsized results for shareholders. And we think, given the marketplace and some of the thawing and some of the dislocation that's happening, we think there could be a pretty unique opportunity over the next 24 months, utilize our balance sheet strength, utilize our scale, utilize our strategic capabilities to step into some pretty attractive opportunities for shareholders.
Great. And Ben, how does the current business environment impact your approach to environmental and social focus areas?
Yeah, thanks for asking on that arena. AvalonBay has been a long-time leader in ESG and sustainability. And on the sustainability side, we are still one of the few REITs that have put out science-based targets for reducing Scope 1, Scope 2, and Scope 3 emissions. So it's a real focus area for the business. On the operating side of the business, I frame it as, what are those win-win opportunities? Where are places where we can both reduce our operating expenses, as well as reduce the imprint that we have on the communities in which we reside and the imprint that we have on the environment? So that's a focus area, particularly around our existing communities. And then as active developers, we're also focused on new development and how do we think about sustainable development going forward. And we are making investments there and exploring ways of, again, sort of win-win opportunities of finding building materials that we can utilize, reduce our environmental impact, but can also reduce the long-term ongoing operating costs of those assets. So it's an area where we expect to continue to lead, and I'm excited for some of the investments we're making.